I mean, in just the last 24 hours, we saw $3 billion just completely evaporate.
Right. Just gone.
Yeah, in forced liquidations. The crypto market went from this kind of dead calm to a Category 5 hurricane just overnight.
Oh, yeah, absolutely.
And the spark for this massive explosion, it wasn't a blockchain upgrade or like, some big corporate adoption announcement. It was a really quiet bureaucratic maneuver by the U.S. Treasury.
Which is wild because it completely upends the traditional modeling of how digital assets are supposed to behave. I mean, we're looking at a market that was really teetering on the edge of a breakdown, and then suddenly it's injected with this just unprecedented level of volatility and buying pressure.
Right. And so welcome to our deep dive into the source material behind this massive sudden crypto rally of August 2026. We are pulling from a specialized crypto market newsletter that kind of lays out the immediate timeline, plus some technical analysis from Benjamin Cowan and regulatory breakdowns from Paul Barron.
Yeah, there's a lot to cover.
There is. So our mission today is to cut through the immediate FOMO, the fear of missing out surrounding this, frankly, crazy 24-hour window. We're going to synthesize the underlying macro triggers, compare the cold, hard technical data to past bear markets, and dissect some highly unconventional backdoor regulatory moves.
Yeah, those regulatory moves are something else.
They really are. And the ultimate goal is to figure out if this is a true market bottom or, just an incredibly well-disguised trap.
Well, the underlying mechanics of this rally are entirely different from the early kind of isolated days of cryptocurrency.
Yeah.
I mean, the drivers pushing prices up right now, they represent a fundamental rewiring of market infrastructure.
Right. And the immediate trigger is a perfect example of that rewiring because the traditional finance mechanism is what just ignited this digital asset explosion. I mean, the market went from negligible volume to an absolute monster rally almost instantaneously. Bitcoin jumped 14%.
14%.
Right, slamming straight into a critical resistance area of $72,000 to $75,000. And Ethereum surged over 20%. Right alongside it, which kind of reinforces that narrative that it could be this cycle's strongest performer.
And you also have to factor in the institutional velocity behind those numbers.
Yeah.
Like Bitcoin ETFs recorded their largest inflow in quite some time. They pulled in roughly $500 million in a single day.
Wow, $500 million.
Yeah, $500 million in one day. And large corporate treasuries, entities like Bitmine, they're remaining consistent buyers regardless of the price action. So the buying pressure was immense, but the catalyst is what makes this specific event so critical to understand.
Okay, let's unpack this because the U.S. Treasury essentially lit the fuse by announcing increased bond buybacks.
Right.
And when they did that, it sent yields and the U.S. dollar dropping sharply. But that macro spark, it hit a market that was incredibly top-heavy with short sellers.
Extremely top-heavy, yeah.
So think of those short sellers like massive industrial springs that had been compressed tighter and tighter as people bet against the price of Bitcoin.
That's a great way to look at it.
Yeah. So when the Treasury announcement drove the initial price up, those springs snapped. The exchanges forcefully liquidated over $3 billion in short positions.
Yeah.
Meaning the system automatically bought Bitcoin on behalf of those short sellers to close out their bad bets. That automated forced buying is the mechanical rocket fuel that blasted the price even higher.
What's fascinating here is how deeply intertwined crypto has become with traditional macroeconomic levers.
Yeah.
Because when the Treasury buys back bonds, they are systematically reducing the supply of those bonds on the open market. Lower supply drives the price of the remaining bonds up.
Yeah.
And because bond yields move inversely to bond prices, the yield, which is the actual return an investor gets for holding that safe government debt, the yield plummets.
So an institutional investor looks at that dropping yield and they realize they can no longer meet their target returns just by holding safe government paper.
Exactly.
They're mechanically forced further out on the risk curve to find yield.
They have to seek out riskier, higher growth assets to make up the difference. And that liquidity pipeline now flows directly into Bitcoin ETFs.
Oh, wow.
Yeah, and simultaneously you have the weakening of the US dollar.
Yeah.
Since Bitcoin is globally priced in dollars, a weaker dollar inherently means it takes more of them to buy a single Bitcoin.
Right, driving the nominal price up.
Exactly. So we are no longer dealing with an uncorrelated asset. Sovereign debt mechanics, Wall Street ETF inflows, and digital asset prices are completely tethered.
Tethered, yeah. That traditional finance plumbing is pumping unprecedented liquidity straight into the crypto ecosystem. Which naturally makes people look at those massive green candles on the charts and just assume the bear market is officially dead.
Right. Everybody gets excited.
Everybody gets excited. But liquidity alone doesn't rewrite market psychology. If we look at the historical data provided in Benjamin Cowen's analysis, all this new money might just be walking straight into a trap.
Yeah, the technical reality check is sobering. The headline grabbing everyone's attention is that Bitcoin just closed above the 200-day moving average.
Right, which sounds good.
It does, because historically, like in 2019 and 2023, crossing that line signaled the start of a massive bull run. However, Cowen's data reveals that this specific indicator is prone to generating brutal false signals.
Oh, really?
Yeah, in 2014 and again in 2019's non-pandemic environment, Bitcoin crossed the 200-day moving average, lured in massive amounts of capital, and then violently reversed to hit a lower low.
Wow, so it's a fake out. And we've also seen similar 20% plus rallies happen in 2018 and 2022 that completely failed to mark the actual market bottom.
Yeah, exactly.
There were just relief bounces in a broader downward trend. And the most concerning part of Cowen's breakdown centers on crucial on-chain indicators, specifically the MVRVZ score and the realized price, which have not reset.
Yeah, the realized price is the critical baseline here.
Okay, break that down.
So imagine a global ledger that records the exact price of every single Bitcoin the very last time it moved from one wallet to another.
Oh.
The average of all those recorded prices is the realized value. It represents the actual cost basis of the network.
Got it.
And the MVRVZ score measures the distance between the current market value and that realized value.
So when the market value crashes down below the realized value, it means the average holder is officially underwater, like they are actively losing money.
Right, they're in the red.
Right, and that specific crossover is what triggers mass panic, leverage washouts, and that final agonizing capitulation phase that actually ends a bear market.
And Cowen points out that this essential reset has not happened yet.
It hasn't happened.
No, the market hasn't experienced that deep structural cleanse. Furthermore, the current market structure is mirroring the 2018 cycle, almost tick for tick.
Really?
Yeah. In 2018, the market rallied straight up to the bear market resistance band in August, which is precisely where we're sitting right now before suffering a catastrophic sell-off moving into September.
Okay, wait. I have to push back on mapping a 2018 chart directly onto today's market.
Yep.
Because if we are mirroring 2018 almost exactly, we are completely ignoring entirely new variables that simply did not exist back then.
Sure.
I mean, we were talking about $500 million in daily spot ETF inflows. In 2018, Wall Street institutions couldn't even custody this asset class legally, let alone pump $500 million into it in a single Tuesday.
Right.
So how can we rely on an 8-year-old chart pattern when the fundamental participants, the infrastructure, and the institutional liquidity are completely different?
Well, the participants have absolutely evolved from retail day traders to Wall Street asset managers. But human psychology remains the constant variable.
Interesting.
Yeah, greed, fear, and exhaustion. They operate the exact same way at a hedge fund as they do in a retail portfolio. Institutions are just as capable of getting trapped in a macro shift.
Okay, that's fair.
So what the technical data urges is a suspension of pure momentum chasing. Because even with massive ETF inflows, trusting a single volatility spike without seeing fundamental on-chain indicators reset is incredibly dangerous. If Bitcoin fails to break that $72,000 to $75,000 resistance band, hold it as firm support, and push higher through September, we are looking at a textbook squeeze and reject pattern.
A squeeze and reject.
Yeah.
So basically trapping all the eager buyers who jumped in on the Treasury news and then pulling the rug out from under them as the broader macroeconomic reality sets in.
Exactly.
Wow. So as the technical data is flashing warning signs of a trap, we have to look for other factors that are artificially keeping market sentiment so aggressively positive right now. And Paul Barron's regulatory breakdown points to some truly unprecedented behind-closed-door shifts in Washington.
Yeah, unprecedented is the correct term. I mean, the mechanics of how these new regulations were introduced bypass every standard expectation of public discourse and market transparency.
Yeah, because the Securities and Exchange Commission just dropped a 400-page rulemaking document completely out of the blue.
Out of nowhere.
Out of nowhere. They abruptly canceled the scheduled public meeting where this was supposed to be debated openly.
Right.
And instead, the commissioners approved the entire proposal via a private shadow vote.
Which is wild.
It's crazy. There was no live stream. There was no public transcript of the debate. They just voted in private and dropped a massive new rulebook on the market.
Passing market-altering regulations without public scrutiny is a major deviation from standard administrative procedure. But the actual architecture of the rules they passed is even more disruptive.
Yeah, the SEC created two specific capital raising lanes,
Right.
but they're exclusively for entirely new token issuances.
Only new ones.
Only new. The first is a $5 million uncapped retail lane that requires zero financial reporting. Zero.
Nothing.
And the second is a $75 million lane that requires full disclosures and caps accredited investors at 10% of their net worth.
Right.
But the glaring issue here is that existing, deeply established protocols like Uniswap and companies like Ripple get absolutely nothing out of this.
No, they're left out.
They are left entirely out in the cold, stuck in the same regulatory limbo they've been fighting for years.
It creates a bifurcated market. Early innovators are penalized with ongoing ambiguity, while the red carpet is just rolled out for untested day one projects. And beyond that, the structural loopholes in this new framework are massive.
Yeah, let's talk about the dumping loophole in that $5 million lane.
Yeah.
Because the SEC requires absolutely zero financial reporting for these new tokens, there is nothing mechanical stopping a single venture capital fund from swooping in, buying the entire $5 million offering in one block,
Oh, yeah.
and then turning around and reselling those tokens to retail investors at a $50 million valuation.
It effectively legally sanctions the exact predatory arbitrage and dumping dynamics that securities laws were originally drafted to prevent in the traditional equities market.
So what does this all mean? If we look at the underlying logic, the SEC isn't just being clumsy here. By leaving legacy tokens in a state of permanent enforcement anxiety and giving a free, unmonitored pass to new $5 million projects, they are implicitly incentivizing a complete market reset. They are actively encouraging developers to abandon 2020-era protocols and start from scratch in an environment the SEC can monitor and mold from day one.
If we connect this to the bigger picture, it explains why the market is rallying despite the flawed logic of the rules.
How so?
Because the industry is so starved for any form of regulatory clarity that it is cheering for a framework that is actively hostile to its own legacy infrastructure.
Wow.
And this is happening in a deeply fragmented regulatory vacuum. Because while the SEC is passing secret rules, the Office of the Controller of the Currency, the OCC, is racing to finalize stablecoin regulations by November.
Right, they're on a tight deadline.
They're trying to establish their own jurisdictional dominance before the Genius Act takes effect in January 2027.
It's an interagency turf war playing out in real time. We even have Injective just registering as an SEC-approved transfer agent, giving them the regulated infrastructure to track the ownership of tokenized securities.
Which is huge.
It's huge. That bridges the legacy financial world directly to the blockchain, all while different agencies are running in completely opposite directions, actively clashing with pending legislation like the Clarity Act. Now, there is a 60-day comment period on the SEC's rule, so the ink isn't totally dry, but it reveals a profound lack of cohesion.
Washington is moving markets through sheer chaos rather than structured policy. And that chaos isn't limited to administrative agencies. The narrative is aggressively expanding into high-level geopolitics and the integration of autonomous technology.
Okay, so before we discuss the political figure mentioned in our sources, I want to make it completely and explicitly clear that we are impartially reporting on the content provided to us today.
Right.
This show does not take sides left-wing or right-wing, and we are absolutely not endorsing the viewpoints of any political figure. We are merely conveying the ideas and events contained in the original source material.
An essential disclaimer given how heavily politicized specific market mechanisms and platforms have become in recent months.
Exactly. So the newsletter highlights that Donald Trump gave a massive public shout-out to a decentralized platform called Hyperliquid, and the market reaction was instantaneous, causing Hyperliquid's token HYPE to jump 17%. Trump stated that the Commodity Futures Trading Commission, the CFTC, is actively working to bring Hyperliquid to the U.S. in a fully compliant and legal fashion.
That statement signals a staggering pivot in regulatory posture. Because for years, the baseline assumption was that offshore decentralized trading protocols would face existential adversarial action from U.S. regulators.
Here's where it gets really interesting. To understand why this validation is so massive, we have to look at what Hyperliquid actually does.
Yeah.
They are one of the crypto ecosystem's biggest on-chain trading platforms, specializing in perpetual futures, commonly called perps.
Right, perps.
So imagine you want to bet on the outcome of a horse race. In traditional finance, you might have to buy a stake in the horse, pay for its feed, house it, and eventually find a buyer when you want to sell.
A lot of friction.
right? A ton of friction. A perpetual future allows you to place a highly leveraged bet on the speed of the horse at any given second without ever dealing with the friction of owning the animal. And the race never officially ends.
Wow.
You are trading pure price exposure with infinite liquidity and near zero settlement time.
It strips away all the physical and administrative friction of asset transfer, and U.S. regulators are no longer trying to ban this architecture.
Which is a huge shift.
Huge. CFTC Chair Michael Selig previously noted that platforms executing this kind of high-speed decentralized settlement could fundamentally transform all financial markets. So the goal has shifted from eradicating the technology to building a legal container for it.
Right. They want to harness the technological superiority of on-chain settlement. And that technology is on the verge of a massive evolutionary leap. The sources include commentary from Bitwise Chief Investment Officer Matt Hugan, who points directly to the integration of artificial intelligence.
Yeah, the AI element.
He projects that combining real-world asset tokenization with AI agents could drive blockchain transaction volume up by 10 to 100 times.
A 100x multiplier in transaction volume is difficult to even conceptualize.
Yeah.
I mean, it requires a complete departure from human-driven trading. We are talking about AI agents like autonomous software capable of executing complex logic without human intervention, managing institutional portfolios, identifying arbitrage opportunities, and interacting with smart contracts 24 hours a day, 7 days a week at millisecond speeds.
But the source material also highlights a terrifying dark side to this leap in volume.
Yeah.
Because crypto industry leaders are sounding the alarm that these exact same autonomous AI agents could be weaponized.
Oh, yes. Absolutely.
They could automate hacks and network attacks at a scale we've just never seen. The technology that makes the market hyper-efficient also makes it hyper-vulnerable.
This raises an important question, perhaps the most critical realization of this entire analysis. The legal and financial frameworks currently being debated in Washington are entirely inadequate for the technology arriving tomorrow.
Totally inadequate.
Think about it. If an autonomous AI agent operating across decentralized perpetual futures platforms discovers a vulnerability in a smart contract and executes a billion-dollar exploit, who is legally liable?
Right, who do you sue?
Exactly. Is it the developer who wrote the initial AI logic? The user who deployed the agent? The decentralized protocol that hosted the smart contract? The legal chain of custody completely breaks down.
The speed of the technological innovation is just completely outpacing the speed of the regulation. We are trying to regulate autonomous software with rulebooks designed for human stockbrokers.
And doing so in an environment where massive amounts of traditional macroeconomic liquidity are being poured onto the fire.
Which brings this entire massive timeline into focus.
Yeah.
Whether you are managing a personal portfolio or preparing for a corporate strategy meeting, the reality is that cryptocurrency no longer operates in an isolated internet money vacuum.
No.
The days of evaluating this asset class purely on its own hype cycles are just over. It is fundamentally tethered to traditional macroeconomic levers, reacting violently to U.S. Treasury bond buybacks and shifting yields.
Yeah.
It is entangled in a chaotic interagency regulatory chess game where legacy protocols are starved and predatory loopholes are quietly legalized, and it is rapidly becoming the foundational infrastructure for geopolitical posturing and cutting-edge autonomous AI.
You cannot accurately model this market by looking at just one variable anymore. It is the absolute convergence point of macroeconomics, bureaucratic warfare, and computer science.
Yeah. It is engineered chaos. Studying the technical charts and the moving averages gives you a small window into the market psychology, but it doesn't prepare you for what happens when the U.S. Treasury, a shadow voting SEC, and autonomous AI agents all decide to rewrite the rules on the exact same day. So we'll leave you with this final provocative thought to mull over on your own. If the SEC's new surprise rules allow $5 million uncapped retail lanes with zero financial reporting for new tokens, and AI agents are about to automate blockchain activity 100 times over, what happens to our financial system when rogue AI agents start autonomously launching, trading, and dumping unregulated microcap tokens on retail investors at the speed of light?